You're listening to The Real Investment Show.
So just for the break, talking a little bit about the FOMC. And it's interesting because, again, in their statement yesterday, they made this very clear was, and this was, I'll read to you from the actual statement. Participants generally observed that a restrictive policy stance would need to be maintained until incoming data provided confidence that inflation was on a sustained downward path to 2%. Now, that's a key statement. It didn't say that inflation has to be at 2%, right? And this is a mistake that a lot of people are making. They're going, well, the Fed's going to hike rates until we get to 2%. That's not what they said. They said that it's got to be on a very clear, sustained trajectory to 2%. So in other words, we go to 7 to 6 to 5 to 4. You've got a very clear trajectory that at that point you're probably going to be heading back to 2, right? So again, it doesn't mean you have to wait till you get to 2, but they just want to see that inflation is coming down to 2% and not just basically pausing before it runs up again, right? So that's the big thing, which was likely to take some time. In the view of the persistent and unacceptably high level of inflation, several participants commented that historical experience cautioned against prematurely loosening monetary policy. Now, that's cutting rates and obviously reversing QT, right? So that's the big thing that everybody's kind of focusing on. So, this is that whole idea that come July, the Fed's going to be cutting rates. Now, the important thing here is to understand is that if the Fed is there's a huge difference between the Fed pausing rate hikes, right? So in other words, they hike to 5, 5.25, 5.5, whatever the number is ultimately going to be, and stopping there and just holding it. That's one thing. It's another thing to be cutting rates, because if they're cutting rates, it means that something has happened economically or something is happening financially in the markets or in the credit market, whatever it is. But there's a problem, and they've got to start cutting rates to try to get money moving back into the financial markets to help heal up whatever is now broken, right? So the only time the Fed is cutting rates is when there's a problem, and either you're in a recession, you've got some type of event going on financially or credit related or something else, right? But there's a problem, and that's why the Fed's cutting rates to try to ease monetary conditions, right? So right now they're trying to tighten monetary conditions to slow consumption, to slow economic growth, reduce demand. That brings down inflation. If they're cutting rates, there's a problem. So again, probably not something that I want to be investing in when the Fed starts cutting rates. That first rate hike or first rate cut, is probably not the time to be buying stocks. Mike, what do you think?
Absolutely. And I put out my article yesterday. It's basically the 3 paths ahead. And earlier we talked about how the market and Fed are diverging in their views. The market thinks the Fed will just gently lower rates towards the end of next year. The Fed thinks they're going to stay the same. I can see the Fed's scenario playing out. If the economy kind of stays intact, the markets maybe are lower, but they're not collapsing. If there's no financial instability issues and inflation doesn't fall rapidly to towards 2%, then yeah, the Fed path may have some validity. I struggle with the market's path that the Fed will do 25 basis points in, say, August and another 25 in November, December, a very gradual decline in rates. That's really never happened. Really, in reality, what happens is the Fed aggressively cuts rates because they're dealing with what we keep saying is something broke.
Yep.
And I think this time will be like the past. Hopefully the market's right. Hopefully this is a very gradual cutting of rates because the economy is stable, because the markets are stable, because there's no crisis on hand. I hope it's right, and that they can eventually get inflation back down to 2%. They can get interest rates back down towards, kind of closer to where they've been, and they can keep the economy afloat without losing jobs. That's great, but that's Goldilocks. That's not the way it tends to work in the real world, and we can all hope that happens. But in reality, we have to understand what's happened in the past. And again, in the past, there have been severe cuts to Fed funds to bring rates down rapidly. And in Bernanke's own words, severe cuts to Fed funds to juice the stock market. He didn't say to juice the stock market, but to push stock market higher to get people to bring up sentiment about the economy, to create spending in the economy. So, this is the Fed that has to, their goal this year is to babysit market expectations and I think market prices.
Yeah.
And if the economy and if all these things can work to their favor, maybe this happens the way Goldilocks would like it to happen, but
but history says that hasn't been the case ever.
Exactly.
It's and look, and if you don't really kind of believe what Mike's saying, all you've got to do is pull up any chart, and there's just thousands of them on the internet right now. Just pull up any chart of historical Fed rate hikes, and what you'll see is that rate hikes, unlike the stock market, they say that bull markets are basically the escalator up, and then bear markets are the elevator down. Well, with Fed rate hikes, it's the same way. It's this this gradual increase in rates until something breaks, and then it's an elevator ride down in rates. And to Mike's point, the drop in rates back towards a new low, and every time since the late 1970s. Every time the Fed has cut rates, they have cut rates to a new lower level than where the previous low was. So each and every time, rates had to come down to a new lower level to get the economy going again. And then when they hiked rates, the rate hike was to a level that was lower than the previous previous peak of rate hikes. This is the only difference this time, is that you can't go lower than zero. We were at zero at the last drop in rate hikes. So again, when we drop rate hikes this time, it'll go back to zero. But I don't see how we get to negative rate hikes. I don't think we get there. We're going to get to zero. But there's going to be a lot of other problems at the point. But it'll be a very sharp, rapid drop in those rate cuts to get back to zero. It won't be, to Mike's point, 25 basis points here, 25 basis points there. That's not going to be the way it works.
And Lance, when were we last at zero? Do you remember?
Yeah, in 2019.
No.
Yeah, because we came out of 2018. The Fed was hiking rates.
March of 2022.
Oh, yeah, that's right. That's right. Last time we were, that's correct. March of 2020.
10 months ago.
Yeah.
Not even a full year ago, rates were zero. Now they're 4.25%, 4.5%.
I got you.
That's how quickly the Fed brought up the Fed funds rate. And there's we keep talking about a lag effect. If that lag effect is a year, and we can debate this all day, and people do, then we haven't even fully felt that first 25 basis point rate hike from March. Mm-hmm. Now we can start talking about all those 75 basis point rate hikes that clearly haven't been felt in the economy.
Right.
And these lag effects, which we drone on about, and I know it's probably irritating to hear about, but this is the reality, is that the pain, the economic and financial pain from those rate hikes is just starting to be felt. The first 25 basis points, raising it from 0 to 1/4, is just being fully affecting the economy. There's still a whole bunch more to go. Every 6 weeks from March, they were raising rates.
Yeah.
And those are just working their way into the economy.
Well, and really, this is a conversation we'll pick up on the other side of the break. But so from a portfolio management standpoint and from an investing standpoint, right? So here I am. I'm sitting on a bunch of cash right now. What do I do? I mean, it's at some point the market should rally, right? I mean, the bear market will be over at some point, you would expect. But again, how do you navigate this issue as you move into the new year with all these kind of headwinds, right? So we've got quantitative tightening. We've got the Fed still hiking rates. We've got the lag effect from these rate hikes. We've got monetary impulses, right? The M2 money supply has dropped just drastically here because of all that kind of fiscal injection that we put in the economy in 2020, 2021 has now come out of the economy. So it really doesn't seem like a great environment to be aggressively bullish in, but this is usually the time when markets kind of surprise you too. So we'll come back and talk about that after the break. Don't go away.
The Real Investment Show.
So welcome back to the show this morning. Michael Lebowitz joining me. So the big question, right? So we're talking about the Fed and what the Fed's doing. And, of course, the Fed is, hiking rates and extracting liquidity from the markets at the same time that they're pulling out liquidity from the markets. We've got, inflation running at 7% plus, and, earnings are coming down. We're facing a potential recession. Our portfolio is positive for the year. It seemed like right now we should just cash out everything and just go sit in cash for this year. It doesn't really seem to be a lot of opportunity. But, the interesting thing about the way markets work is that despite all of these obvious headwinds, markets have a tendency to surprise you sometimes and do things that you don't expect to do. Again, we've laid out a very bearish case this morning, really, for the markets from what the Fed's doing and what's heading. It seems like as I said, the obvious thing is like, why even be invested, right? Just go sit in cash. Well, the problem with that is again, there's been a lot of damage to the markets in terms of stock prices. Meta down 50-60%, Tesla's down 60-70% from its peak. I mean, a lot of stocks have really, really taken a beating this year. Small caps, mid caps, large caps, to a large degree, have all taken pretty substantial hits. Yet the market overall hasn't come down that much. Market's down about 19% from its peak. So again, it seems like a bear market. It feels like a bear market, but markets have really held in a whole lot better than you would have expected, I think, in an environment where the Fed was aggressively hiking rates. I think at any other point in history, if markets were operating on a fundamental basis, rather than this kind of passive indexing environment that we live in, markets would have been down substantially more than where they are. We would have probably been talking about a market down 30 or 40% rather than 19% last year, actually 18.1% total return basis last year. So, that's the challenge here for investors. And, how do you allocate money to the markets and try to participate here in an environment with such obvious headwinds, but where a market, because of passive index flows, and again, ETF flows last year, very strong. People put a lot of money into equity ETFs last year. Despite the fact of what market was going on, we haven't really seen that capitulation of what we would normally deem a bear market. In a bear market, nobody wants to own stocks. In this environment, we've had just record inflows of money into passive ETFs because people are convinced at every moment they don't want to miss the bottom if the Fed pivots, so they keep putting money into ETFs hoping to catch the bottom. And that's a very different environment that we're in. And this is what's going to make a real challenge this year and to managing money. Again, you can take the opportunity and say, I'm out, I'm just going to sit in cash, and this market can take off running because, again, the markets are pricing in what the Fed is doing. The market is trying to front run what the Fed is doing. The market is trying to outthink the Federal Reserve and what's going on economically. They're pricing in expectations for a reduction in earnings. They're pricing in an expectation for a recession. That's all being done psychologically. There's so much talk about a recession. There's so much talk about Fed rate hikes and all these type of things. The market's already adjusting for all of this. And again, this is going to be one of the most forecasted, predicted recessions, if it occurs, in U.S. history, because everybody's talking about it, which brings up the risk that the markets can do something quite unexpected and start to rally much sooner than would make logical sense. And this is one thing that's going to be a big challenge for both Mike and I to manage money this year, is how to navigate this market. It's going to be a year, I think, with a lot more volatility. Mike, your thoughts?
Yeah, I think this year is going to be much harder than last year. We started last year, day one of last year, we had a high level of equity exposure. And day one, we started reducing our exposure. I think we pulled off 6% of our exposure on that very first or second day of the year. And the reason for that was because we thought the Fed would start raising rates, that they had to combat inflation, that inflation was on the rise. And look, we didn't expect the Fed would get up to 4.25%, but we thought that we'd be going into a tightening monetary policy regime. And that's what happened, and stocks trended lower. And we had reduced exposure throughout the year, equity exposure throughout the year. This year seems difficult because, like you said, passive flows have not stopped. So one of the things we have to keep in mind is, will something happen this year where passive investors, where individuals say, you know what, my 401k, which right now gets 80% of my contributions to stocks and 20% to bonds, bonds are at 4 or 5% now. I'm going to switch it to 50-50. Or, you know what, stocks are going nowhere. I'm just going to get out of stocks. I'm going to go to cash. Like you said, I can earn 4%. So the first question, or first thing that we always have to keep on the top of our mind is it possible that those passive flows into the market that just are coming in every other week, every time someone gets a paycheck, that they will reverse, that that flows will leave equities and go to cash or bonds or commodities or wherever else they may go. So, that's top of mind. But I think this is the year we kind of prepare for the worst, hope for the best, and reality will be somewhere in between. The Fed is telling us they're going to raise rates through March, April. They're going to keep rates where they are. The lag effect of all those rate hikes from last year will just slowly work their way into the economy. We're seeing some decent deterioration in economic data. It's just not in labor data. And I think the Fed wants to see a weakening of the labor market because their biggest concern is Paul Volcker's from 40 years ago, that inflation comes down and then pops back up again. They had 3 waves of inflation back in the 70s and early 80s. And I think the Fed's biggest fear is that they take their foot off the brake too soon and inflation comes back. With that, their credibility falls. And with that, stock prices get hit much more. Inflation could rise more than it did out of fear and concern from consumers that inflation isn't a one-time event because of the pandemic, but now it's become part of the economy due to monetary policy, fiscal policy, and just consumer behaviors. So, I think this is a year to be very careful, to expect a lower trend, but to understand that just because we expect a lower trend, stock prices can't go higher. And, while we may talk a lot about a bear case, Lance and I spend 75-80% of our time talking about where's the bull case, where are we wrong, why would the market go higher, what could cause it to go higher. And I think you need to keep your head on a swivel and you need to think about where your thesis is right and where it's wrong and adjust that thesis. What we're talking when we're talking in 2 months in March, we may have a completely different view. And stock prices may be a lot lower or a lot higher at that point. Inflation may have come down or is being stubborn, and the Fed may be doing something completely different than they're doing today. So I think the word of the year is going to be audible. We have to be ready to be audible and know what we're audibling into.
Yeah.
We have to have 4 plays called, and we're at the line of scrimmage every day. Yep. And maybe the first play is not the play. Maybe it's that second or third play that we have to audible to. And I think that's going to continue through this year. It's going to make it a very challenging year.
Yeah. And again, there's a lot of, media headlines out right now about there's never been 2 down years in a row. And a lot of that has to do with calendar quirks. So you've got to be really careful with that type of analysis because, bear markets start, markets are up, 10, 15%, whatever. And then the market starts declining in the beginning of one year, doesn't get to a negative return, but the bear market actually started in the year preceding whatever negative year and a half, but it's kind of a calendar thing. But again, there's only been a couple of years or a couple of periods throughout history where there's been 2 negative years in a row. So a lot of investors kind of hanging their hat on. It's like, oh, this year will end up positive because there's never been, very rare there's 2 negative years in a row. Just be careful with that. Like Mike said, it's possible. Again, we could be talking about the resumption of the bull market later on this year. I, just don't know. But the question I think really comes down to the fact is, do we have a recession? How deep is that recession? And more importantly, do earnings and estimates for earnings, most importantly, revert to some level of normality where valuations and prices and earnings, going forward kind of get back into some level of reality that are sustainable. So, to Mike's point, it's just going to be a year where, this month we're talking about, being mostly in cash. Next month we may be talking about having a lot of equity exposure. It's just going to be a year where dynamics are going to change. What worked last year may not work this year. A lot of people piled into energy last year because it was working. Something that Mike and I had talked about on the show back in November of 21. We talked about increasing our energy exposure because it was so hated. That was the sector that everybody hated, and it was a huge winner. It was up 40% last year. Markets were down 20, right? So that's a huge outperformance. Probably not going to happen again this year. So, it wouldn't be surprising at all to see energy underperform. And then, of course, you start looking back at what's most hated right now, which is technology and consumer discretionary. Those are the most hated stocks right now. Maybe those are the big winners this year. Maybe they start getting some inflows this year because of changes to or realization that maybe things aren't as bad as everybody expects. I don't know. But Mike, closing thoughts. You got 10 seconds.
Keep your head on a swivel and be ready to Audible.
There you go. All right. Get by the website, realinvestmentadvice.com. Send us your questions, comments, emails, as always. And again, we'll keep you updated on what we're doing. As we make audibles, we'll let you know. But again, our daily commentary is out this morning. Make sure you're subscribed. We send out a daily commentary every day. It's a quick read, about 3 minutes. We give you a market trading update, interesting tidbits about the markets, and more. It comes out every morning at 7:30. Subscribe at the website, realinvestmentadvice.com, and we'll see you back here tomorrow. Don't go away.